Hi, thank you for listening. My name is Larissa Greene. I'm with Advanta IRA, and today John Schaub will join us, and he's going to talk about investing strategies for today's real estate market. This is going to be recorded, but I will share the slides. So if you would like a copy of the slides, you'll have information on how to get them from me, and you can email me and make that request. So as we go through, I'm going to talk a little bit about Advanta. I'm going to talk a little bit about self-directed IRAs, and then I'll introduce John. So again, my name is Larissa Greene. I'm with Advanta IRA. I have been for almost 13 years now. I started out with things like helping clients make investments, open new accounts, transfer money in and out of IRAs, also paying expenses on behalf of IRA accounts, and receiving income. And then probably about 11 years ago, I moved over to business development, education, and marketing, and I've been there ever since. So if you're listening to this recording and you're local to one of our offices, either in Florida or Georgia, we may have seen each other out and about. I do a lot of networking for Advanta. If you have any specific questions about a self-directed retirement account, you can reach me at the contact information here on this slide. A little bit about Advanta: we do not provide investment advice. We don't endorse any products. We don't give legal, tax, or advice otherwise on investments you're making. So please make sure that you're comfortable with the deal and the person you are dealing with. If you have questions that we can't answer, we might refer you over to a professional that has helped our clients in the past. We have been doing kind of the same thing for over 20 years now. Actually, I think this is our 23rd year of handling self-directed retirement accounts, and we have over $3 billion in assets under administration. As I mentioned, we have two offices. We're in Clearwater, Florida, and in Atlanta, Georgia, but we can help anyone anywhere. And the biggest difference between us and our competitors, every client receives a dedicated account manager who they reach out to for anything they need for their self-directed account. So that could be paying an expense, receiving any income, making an annual contribution, transferring money in, or making an investment. And that individual is your point of contact for everything. So that gives you the opportunity to get to know the person that is going to help you with that account. And I think that really makes us stand apart. We have events going on all the time, just like this one. We do webinars usually twice a week, and once a month we have a networking event on the last Friday of every month. We also keep you up to date with industry news through our podcast and our blog. So I know that if you're listening to this, then you're signed up for those. And you can always suggest topics to us as well. So please feel free to reach out. All of that information is to help you kind of stay in the know. And so we like to keep that up. A self-directed IRA is actually something a little unique. So a lot of times people will say to us, well, I already have a self-directed IRA. That account is with my broker. I can choose the investments, how much I want to make as far as investing goes, and when I can trade and sell. And that is a great way to self-direct your IRA, but our definition is more specific. We actually don't sell anything at all. We simply hold the account, you find the investment, and we help you get it done in the name of the retirement account. And so that allows you the opportunity to truly diversify your retirement dollars. And there really isn't a list that the IRS has provided us that says, okay, this is what you can invest in. Instead, they've provided a very short list of asset classes you cannot invest in and people you cannot deal with when it comes to your IRA. But outside of that, the sky is just about the limit. And I always like to provide this quick list of alternative investments to really kind of get you thinking about the types of investments you might make in a self-directed account. So of course, real estate. And then there are many forms of real estate. So you can buy and hold single family homes, you can buy condos, duplexes, but it really, you can go into so many other things. You can invest as a limited partner into a syndication or private equity. You can lend money in the form of a mortgage or deed of trust. You can invest in real estate options, for example, but then outside of real estate, precious metals, cryptocurrency, we see a lot of that stuff. We also see people lend money with notes secured to things outside of real estate. And the list truly does go on and on. So that just gives you an idea of what we're seeing on a regular basis in a self-directed account. And again, that's your opportunity to truly diversify your portfolio. So now we're going to bring John on, and he's going to tell us a little bit about himself and his upcoming class, and we have some questions for him as well. How are you doing today, John?
I'm doing great, Larissa. It's nice to be with you.
Thank you.
I've been doing this for a long time, as Larissa knows, and my friend Peter Fortunato and I have been friends since the 70s, and we've been investing together and teaching together since the 70s. And so we teach to tell people what we're doing and how we're doing it to show them a way that they can invest with less risk and higher profits. And we also show them about the mistakes we've made, because if you've been invested for a long time and been involved in a lot of deals, a lot of different people, you certainly will make some mistakes. So we tell both sides of the story. So I'm excited to be teaching with Peter again in Tampa here, April 5th and 6th. We only teach once a year together typically. And this is going to be an exciting year to teach because change is in the wind. If you've been watching the news or watching the stock market or watching the real estate market, which I do, of course, every day, we know that things have changed. I rented 2 houses just 2 weeks ago, rented them both just in a couple of days for a full retail price. So there seems to be a lot of tenants in the market yet. But the one reason maybe there's a lot of tenants is they're not buying as much as they used to. You know, the sales market is slowing down. So we'll deal with all the changes that are happening. And, I wrote a book years ago about how to build wealth in a changing market, and it's worth reading if you haven't read it. But markets always are changing, and we have short-term and long-term changes. And so it's good for you to have both short-term and long-term goals. Your long-term goals, you probably shouldn't change much during a change in market. For example, if you have a goal of owning 5 houses free and clear or 10 houses free and clear, you wouldn't want to change that goal. But how you achieve that goal and the number of properties that you buy this year and the price that you pay for them and where they are, all those things could change. So there's a lot of things that you can't control, like inflation and the government policies, but there are many things that you can control, like which property you buy, which neighborhood it's in, how much you put down, how you finance it, who you rent it to. And if you're like me, you like real estate because it gives you control over a lot of these things. And the control side of it is important to me, contrasted with the stock market. And we've all probably owned some stocks, but you really don't have much control after you buy a stock. You don't have much influence over how they run the company or what decisions they make or the stock market itself. So that lack of control bothers me and a lot of people. So if you're on the side with me where you like to have control, some control anyway, and we all know you don't control everything, but in the finance business, in the real estate business, once you learn a lot about it, you can do things more safely. You can really lower your risk or just almost take your risk down to zero. And by doing that, you sleep well. There's more to what we do than just making money. A lot of it, a lot of the reasons that we invest in real estate is lifestyle. We have found that by investing in real estate, first of all, it can be profitable. But second of all, it doesn't require me to work at a job where I have to work a regular schedule or 7 days a week or, be on a call 24/7. And a lot of jobs require that, of course. My dad grew up, he was in a retailing business. And when he first started, it was like a 9 to 5, 5 day a week job. But over the years, about retailing now, they're open 7 days a week, and they're open almost all the time during those 7 days a week. So there are some jobs that don't give you the lifestyle that I wanted. And the lifestyle we wanted is time to spend with our kids and our grandkids now, and be able to do things on a schedule that we want to without, having to have a rigid schedule. Now I do work. I still manage all my own properties. When we have a little excitement in the market, like we're probably going to have here the next couple of years, I'll still be buying. We do sell occasionally, not often, but we tend to buy properties, and I'll talk about this a little bit more in the class, but I tend to buy properties that I want to hold for a long time. And that's an important concept. A lot of people buy things and their intent is to sell them as soon as they can to make a profit. You call these people sometimes flippers or fixer uppers. And there's nothing wrong with that business. In fact, if you're really good at it, it can be pretty profitable. People who get into that business and are not good at it, have never done one before, find out the hard way sometimes that it's not as easy as it looks. You know, it's not like a television show where they seem to be able to fix something up in just a couple of weeks and sell it for a big profit. And that's not the real world. So I am not in the fix and flip business. In fact, I don't like to buy things that I have to do major rehabs on, because I find over and over again that when I do a major rehab, it almost always costs me more than the budget, and it almost always takes longer than I anticipate. So that means you have a property off the market for a while, and you know, your cash flow is going the wrong way. It's not coming in; it's going out. So I look to buy properties. I'm pretty focused. I'm a picky buyer. I don't buy a lot, but I bought probably over 100 properties during my career, well over 100. But you know, I've been doing this for more than 4 decades. So if you do the math, that's just a couple a year on an average. It's not a lot. And if you're a picky buyer and a very focused buyer, then you won't make as many mistakes. You know, talking about focusing on certain properties, certain types of properties. I've owned a lot of different properties. I've owned car washes, motels, restaurants, all sorts of land deals. But I've found by doing this that sometimes those are profitable, sometimes not so much. They all require a lot more work than my normal investment, which is a house that I rent to somebody for a long period of time. I just lost a tenant that had been with me for 42 years, and they would still be with us, but the house is out on Siesta Key. It's out on the beach, and we had a hurricane in the fall. And for the first time, and I've owned that property for 50 years, first time in 50 years, it flooded. And when it flooded, of course, it was a traumatic event for the people who were in there. So they lost a lot of their stuff, and they decided they didn't want to ever do that again. So they moved off the island. They're someplace high and dry, I assume, right now. But if you can buy properties that you can rent to a tenant for a long period of time, and the last property I rented, the people want to stay there for, you know, I asked a question on my rental application, how long? And one of the first questions I asked them, how long do you want to stay in the house? And these people wrote in the rest of our lives. I kind of like that answer. I like people that have a long-term outlook and they like this house well enough that they're going to move in and do this. These people who've already done some work to the house on their own, move in and take good care of the house and stay there for a long period of time. Because that makes it a truly passive investment for me. So the rate of return I make is important, but which is more important, and the question I always ask before I buy anything is how much of my time will it take to manage this property after I buy it? And that keeps me away from things like car washes and motels and restaurants here as I've grown wiser. So what you find though, when we have a down market, when people are selling things at bargain prices, that it's easy to get tempted to buy something just because the price is cheap. And that's not a good strategy. You shouldn't, if you have a goal of owning certain types of property over a period of time, and let's just use it like in my book, Building Wealth One House at a Time. I talk about buying one house a year. You don't need to go at a fast pace. One house a year is more than enough for most people. And then holding those houses until you have enough houses to sell some and pay off the other ones and reach your free and clear goal. So if your goal is 5 houses free and clear, and they would make you $2,000 a month each in your town, that would be $10,000 a month. You know, that's your financial goal, and set your goal in terms of cash flow, not just numbers, you know, but cash flow. So, you know, and not the value, not the net worth so much as the cash flow. You can have a net worth of $5 million and have negative cash flow if it's the wrong property or if it's financed. But if you have free and clear property, that's going to be the type of property that'll produce the most cash flow and it'll be safer. And if you've bought the right properties in the right neighborhood, right houses in the right neighborhoods, and you've rented them to people who will stay for long periods of time, it takes a very little bit of your time to manage those properties. I manage all my properties. I own quite a few properties. but it's not a full-time job for me. Now, I don't do any of the work. I don't go out and fix houses. I don't paint them. I don't do the yard work. I hire all that done because if it's a real investment, you have to look at your net income. And if you're spending a lot of time, and I'm not opposed to people who like to do this. You know, if you like to fix things, if you like to paint or whatever it is that you like to do, sure, go ahead and do it. You know, if that's your recreation, that's not a problem. But to be honest about the rate of return you're making on your money, you should be able to afford to pay a plumber, pay a painter, pay the yard people if that's what needs to be done, to tree people. And by doing that, now your rate of return, your return you're making on your money is the net after all those expenses. So I look at the net, and I don't uh, get involved in the physical labor side. I hire all that done. I use the same people over and over again, which is important because, like for example, when we had a hurricane, I had a roofer who had put on probably 25 roofs for me over the last 10 years. So I called the roofer up and I said, I've got 5 roofs that need repair. And he went out and repaired all 5 of them the week after the storm. Well, most people don't have access to repair people like that because they don't use the same people over and over again and they don't pay them. Well, you know, I pay people as soon as they do the work or as soon as possible after they do the work. And I try to use the same people over and over again. And I'm not necessarily looking for the best price. You know, I'm looking for a fair price, but I'm looking for good service. One of the secrets to keeping a long-term tenant, you know, long-term tenant, if you ask a really good tenant what they're worried about, there's 2 things that they're worried about. One is they're worried that the landlord's going to sell the house, so they'll have to move. And 2, they're worried about will the landlord fix things if you know when there's something that needs to be fixed. So I tell people when they move in, because it's true, that I don't have any plans on selling this house. And if I ever did sell this house, I give you the first right to buy it. I don't want people to worry about moving out of the house right away. And then the second thing we do as things are needed. If something breaks, we get it fixed as soon as we can. Now, that's not always the same day. I had a tenant call last week that had a garage door that wouldn't go up. I called my garage door guys, and he said, I'm out of town until Monday. Will that work? And I said, I think it will. So I called the tenant back and said, we can't get your garage door repaired until Monday. Is that okay? They said, sure. So as long as they know it's going to happen fairly soon, it doesn't have to happen immediately. Now, some things, you know, if there's a broken water pipe or, you know, a dangerous electrical situation, you'd want to move more quickly on that. So it's good to have maybe backup people. You know, I have a plumber and then I have a backup plumber just in case my primary plumber is out of town or too busy to do the work. And same thing with a couple of things, but things like roofs and trees, you can use the same people over and over again. And as long as you get good service, and you will get good service if you keep using the same folks, hopefully, then it's good for both sides. And that's the way you keep your expenses at a reasonable level. If you keep switching people and you know you call a plumber that you don't know or an electrician you don't know, the price could be significantly higher than somebody who does regular work for you. We know about what it costs to operate a house. I'll just give you some round numbers, but it costs about 20% of the gross income to maintain that house. It costs another 20%, round figures, to pay the taxes and the insurance on that house. So about 40% of the gross income disappears. Okay. Now, over time, your rents go up faster than your expenses do. So you get a little bit better spread. But taxes and insurance do go up, and maintenance costs do go up. So even though we may get down at like 36 or 37% after a while, typically we're still pretty close to that 40% number. Now, if you're new to the business, you might think that's a high number, but nationally, uh, professional property managers figure 50% on most of their expenses. So about half of the income disappears. And that's why somebody who's just new to the business sometimes gets in trouble because they don't understand that it's going to cost a lot of money just to operate a property. And that's one reason that a lot of the big buyers are selling now is because they have some experience and they miscalculated how much it was going to cost to maintain these buildings, and they were way off. So their maintenance costs are eating them up, or they're simply not maintaining them, and that's certainly a bad strategy. So moving along, um, we have about 12 things we're going to talk about in the seminar. There's a brochure or a flyer that I think Larissa will put up on the screen or can send to you. But we're going to talk about a lot of different things. We're going to talk about uh, strategies for both offense and defense here as we go into a changing market. You know, ways you can protect what you have already and ways you can be a little more aggressive when you're buying and borrowing in a market that's changing. We're going to talk about the keys to getting cash flow. And folks who are new to this and just go to a bank every time they buy a property, or they go to a hard money lender when they buy a property, uh, are not uh, doing uh, the wise thing. And because of that, they're paying way too much for their money. And they're paying the lenders a large share of their profit. So once you learn how to finance properties without going to banks and without using hard money, then your cash flow will go way up. So we're going to talk about a lot of different ways to structure deals, to put deals together that give you cash flow from day one. When I
Hey,
started,
Chad.
yes, ma'am.
On that note, I did have somebody ask some questions they had emailed into me, kind of about cash flow and the changing market, and maybe some strategies that you would typically use in that kind of change. So, one of the questions was about seller financing, and typically with seller financing, the property taxes are still going to be, reassessed because the property is changing hands. Do you find that that is I guess the question would be, do you take that into account when you make an offer for seller financing, or are you thinking, okay, well, this is what the property can bear because things like tax and insurance will go up?
That could be a long answer to that question. You know, if somebody is trying to keep the same property tax cost, that means that if somebody owns a property and it's their homestead right now in the state of Florida, it's their homestead, they're getting a break because it's their homestead and they own that property and they live in that property, right? So if you buy that property from them using almost any technique, it doesn't have to be a straight purchase or owner financing. It can be even a lease option where the title remains in their name. The property taxes still could go up because they won't be living in the property anymore. You know, they're going to move out. And if they move out of a property they had homesteaded, they're going to lose that homestead exemption. Now, that doesn't mean they're going to reassess it. They will reassess it typically when the property gets sold. But my advice to people is, you know, if you're trying to do something clever to keep the costs down, and it's a short-term strategy, that'll work for the short term. But eventually, your costs are probably going to go to market, whatever that is. And that's why we plug in this 20% number for taxes and insurance. None of our houses have ever been or homesteaded. You know, all our houses are rented. And if we buy a house from somebody who lives in it now, we know that the taxes are going to go up, and we do our math, we do our projections based on the new tax cost, because it's certainly something that's going to happen eventually to everybody, no matter how you buy that property. So I can give you several ways to buy and keep the people in the house. I mean, that's one way to do it. If I'm buying a house from you, it's your house and it's homesteaded. We don't want to change the title to that. We leave the title in your name, and I can participate either with an option or a mortgage with participation agreements. So we can do things that are clever that'll work for a while. But none of these are 20 or 30-year strategies. They're all relatively short-term strategies. So eventually, you're going to be in a situation where the property taxes will probably go to market, and you might be able to defer that for a few years. But when they go to market, if you can't afford the house or it's not giving you a decent return, then you end up selling it. Now,
Hmm.
you can try to be clever and put it in trust, And I've seen people put things in trust and then change the trustee and they change the beneficiary. But not these things are again relatively short-term strategies because if they find that this house is rented and the owners have moved out, again you lose your homestead, and there's a possibility that they would reassess that too.
Okay, got it. And also kind of along the same lines of, having a property cash flow in a lot of areas, if someone lives in a metro area where home prices are really high, say a million plus, um, do you typically find that you would look in other markets, and how would you establish what other markets you would look in if home prices were just too high?
Well, the reason home prices are high is because they've gone up. So the people who have owned those houses for 20 or 30 years are probably pretty happy that they went up. It's pretty interesting how things change over time. But the typical house that I own today, that I paid when I was buying a lot of houses, I was buying them for 50, 60, 70, $100,000. All those houses are worth four or five or $600,000 today. Now, can you buy one of those houses for five or $600,000 today and still have a good investment? The answer is yes. It depends on how you finance it. Depends on what you pay for it. But you have to make offers that allow you to do that. You have to make offers that have low enough payments on a monthly basis to allow you to own that house. And there's a combination of both equity and debt financing. For example, if I found a $500,000 house that I could buy for 400,000 because the people had owned it a long time and they were just fed up with it, and they just want to sell it and get out. And I did the math and I found out that it wouldn't even support a $400,000 loan, but it would support a $300,000 loan. What I would do is find an equity partner who would come in with $100,000 for the down payment. So we'd only have a $300,000 loan on it, knowing that with a $300,000 loan, the house would have positive cash flow. So it's a combination of a couple things that get you to cash flow. And there's many more creative ways than that. It's not fair to your people to go into a lot of detail over the phone here. But if you come to class, we'll go into depth for 2 days on creative ways to structure deals, and you'll see many ways to put deals together that'll give you cash flow from the day one. And there's a trade-off between cash flow, typically cash flow and growth. For example, you can still buy a house in my town for $40,000 or $50,000. But that house has not gone up much over the last 30 years. It's still only worth $40,000 or $50,000. And the house maybe a couple miles away in a much better neighborhood, much better part of town, might be worth $300,000 or $400,000. Same size house. It's not so much the house itself. It's the value of the neighborhood. It's the value of the lot. And you've probably heard me say this, but I've said it many times, that it's really the land underneath the building that's going up in value. Buildings wear out, buildings become obsolete. I bet you if you look around your town, there's people tearing down houses and they're not that old. They may only be 20 or 30 years old, but they're tearing them down and they're building a bigger house, a more modern house. But the land underneath that house has gone up quite a bit. So when we buy properties, we spend a lot of time analyzing not just the house. We look at the house, but we really pay attention to the dirt underneath the house and ask questions like, is this a good lot? Is this a lot that we could sell to somebody else who want to build a better house someday? Is it in a good school district? Is it close to shopping and schools? And the people really want to live here, and the utility is good. So you dig into the dirt side of it as much as you do the house side. And then, of course, when you buy a house, you want to make sure the plumbing works and the windows work and the AC works, and all those things too. But the primary focus for my investments has been the land more than the house. Did you have another question?
Yeah, I was just reviewing the question. I think you really covered it, but he was also asking about, sort of the insurance crisis and how, if
Yeah.
you, and you kind of touched on it already, sometimes you have, prices, you're paying down, of course, the financing, and you have rents go up. And so then you have a bigger spread, but then you might have more expenses down the line. So I guess that really kind of falls under the insurance crisis. But as the insurance goes up, are you looking at different ways to continue to cash flow those properties?
Well, there's different ways to look at insurance. When I buy houses, for example, some of the last houses I bought for $300,000 or $400,000, and the land was worth $300,000 or $400,000. So I was buying them for just the land price. Now these houses, I mean, these properties have houses on them. They both had a 3-bedroom, 2-bath house with a garage on them that rents for $29.50 a month. So what you're really insuring is that building that rents for $29.50 a month, and saying, if I wanted to, I could tear the house down and I could just have a lot that may be going up in value 10 or 15% a year, but I gave up to $29.50 in rent. So it's a trade-off, and if you don't want to deal with insurance, you don't have to insure things unless, of course, you have a bank loan, in which case the bank is going to require you to insure things. But we structure deals on a regular basis where we can participate in profits without owning the property. And by not owning the property, we don't have the responsibility for the insurance. Or if I buy something that's worth, the land is worth 300 and I can buy it for 300, I don't really feel a need to insure that house as long as I'm okay with the house just disappearing on me one day. Now the odds are pretty good the house isn't going to just disappear. Of all the times I've been doing this, all the tenants and all the houses, we've only had 3 house fires. We've never had a house totally disappear. So the chances of the house becoming totally unrentable, even with the floods we have houses that have flooded, or a house actually that has flooded, but it's repairable. And I don't insure it for floods. I don't insure any of my properties for wind damage. Because what we found during the last storms here, we had several storms last year, is that the insurance wouldn't have paid me a dime. The deductibles are so high on insurance that they wouldn't pay me anything. So unless you're required to carry insurance, you make a business decision on whether or not you should insure it. And we found over and over again that not carrying insurance, and I'm talking about casualty now, not liability, not carrying casualty insurance. So we think the risk of fire is pretty low, the risk of flood, risk of wind damage is pretty low. But you use common sense. And if you buy something in an area, if you bought a house on a river, if you bought a house on the beach, if you bought a house on a valley that burns every 3 or 4 years, well, then you either carry insurance or you choose not to buy there. So it's more complicated than most people think. There's more things to think about here.
Yeah, that makes sense. Thanks, John.
Well, a lot of other things we're going to talk about. Cash flow is certainly one of them. So there's a balance here between appreciation. Does the property actually go up in value over time, and the cash flow? And I found it's about a 50-50 balance typically, that we get just about as much cash flow from the rents as we do from appreciation. But the reason I own houses instead of land, I used to own a lot of land, is when you just own land, you give up that half. You give up the cash flow half of your profit. So you make twice as much profit owning an improved property if it's managed well and it's the right property and all that. And the people who live in high price areas, and you're talking about people in $1 million areas, a lot of my students live in areas where typical houses are well over $1 million now. And they've been buying these houses for years. They've always been expensive in those areas. If you go to New York or Orange County, California, or down even Coconut Grove, I mean, there's areas that have been expensive for a long, long time. And the people who could figure out how to buy those properties and hold them have made much more money than the folks that have just gone after properties that had more cash flow and less appreciation. So I encourage you to look at any property you look at. See if there's a balance between the cash flow and the appreciation. And if it's too one-sided, if it's just cash flow, if you go out and buy a $40,000 or $50,000 house and it rents for $500 a month, you'll probably have more cash flow, but you may come back in 10 years and find that house is still worth $40,000 or $50,000. One of my students from California owns a lot of properties in California, which appreciated substantially. And I've owned properties with him, so I know the prices here. We've owned properties together. He bought a bunch of properties in Iowa. He was buying properties in Iowa for $30,000 and $40,000 that he could rent for $500 a month. And he did that because the cash flow from those houses allowed him to buy more properties in California that had far more appreciation, but a lot less cash flow. 20 years after he bought those properties for 20 or 30 or $40,000 each, he sold them all for the same price that he paid for them. He got zero appreciation on those properties over 20 or 30 years. And when you think about it, that means they really went down in value because the dollar certainly changed over that period of time. So if you buy a property just for the cash flow, and you can do that, you can buy long-term leases. I mean, you can buy a lease that'll pay you a 5% return, and it's got 25 years yet to run on it, but it's going to be 5% based on today's value. If you don't get the increase in rents over a long period of time, you're going backwards because inflation is causing the value of that dollar you're collecting to be worth less and less. You know, it's going to cost more money to buy cars and eggs and everything else. So uh, don't know how I got off on that tangent, but so I, a couple of things. Warren Buffett and Charlie Munger have always been two guys I've studied because we do a lot of the same stuff. You know, and I don't know if you've studied either one of these, but before they got together, Warren liked to buy things cheap, cheap, cheap. You know, he liked to buy things at the biggest bargain price he could get. And Charlie Munger talked him into paying more for the properties, but buying better quality properties. And I've certainly found that to be true. Over the years, when I first started, I would buy just about anything that I could buy with the money I had and the financing I could put together. But as time went on, I was pickier and pickier about what I bought. And the higher quality properties have paid me much higher dividends, so to speak. They paid me much more in rent and much more in appreciation than the lower quality properties. So if you're on the fence about this, and if you're thinking about how do we do this, come learn a way to do it. There are ways to buy high priced properties and have cash flow to start with and have a share of the profit down the road. You may not get 100% of the profit, but you may end up with 50% of the profit or even 20% of the profit. And 20% of $1 million profit is probably more than a whole bunch of $50,000 houses you're going to buy. So it's two different ways to look at it. I've always thought that fewer moving parts was a better strategy. So the fewer properties that I could own, the smaller the number of the properties I could own, the happier I'm going to be. Now, if you take that to the extreme and you just own one property, maybe it's a shopping center, well, things can go wrong, can't they? In the shopping center business, there's a lot of empty space right now. And one of the things in the Wall Street Journal last week was talking about the mortgages on the shopping centers, the mortgages on commercial properties are now being sold. They're chopping them up into pieces and they're selling them just like they did back in 2008. The title of the article, if you want to read it, is "Now They're Back." They crashed the economy in 2008, and now they're back. So the finance guys are doing pretty much the same thing they did in 2008. This time more with commercial properties, commercial mortgages, than with the residential mortgages. But with all of them, there's a lot of money to be made when you transfer a mortgage from one entity to another at some kind of a discount. And so they slice and dice in these mortgages every way they can, and everybody's getting a commission on them. But it makes it really hard to analyze what you own, and there's going to be a lot of defaults in that area. And if a bank has mortgages that are both commercial mortgages and house mortgages, and the house mortgages all pay on time, but the commercial loans stop paying, well, the bank's got problems. And when we have a downturn in the economy, it's sometimes not due to businesses making bad decisions. Sometimes it's due to the contraction in the money supply, which means pretty much everybody just kind of holds on to what they have, okay, rather than spending as much. And the banks stop lending stop lending. They tighten up their lending standards, or they just quit lending at all. And I've been through 8 different recessions, and in every recession, the banks quit making loans to investors. So if your primary source of financing is a bank loan, and the banks quit making loans to investors, you're going to not be able to buy in a market where you want to buy. In a market where prices are cheap. in a market where people really are anxious to sell, so they'll make you a real deal. We bought as many as 16 properties in 1 year sometimes when builders were just giving properties away because they couldn't afford to make payments. They just wanted to get out from under the debt. And we would make deals not only with the builders, but we make deals with the builders' lenders because the lenders didn't want to take these properties back either. And it's really hard to tell what the future is going to bring. But I've got a feeling that we're probably in for a couple of years here where there'll be more bargains, there'll be more opportunities to put together deals with really good financing and at fair prices. And so back to what I was talking about earlier, I encourage you to buy the highest quality properties you can, right? Rather than buying a whole bunch of properties, focus on quality. Buy the highest quality properties you can. Set goals and set your goals in terms of cash flow. So if your goal is to have $1,000 a week or $1,000 a day in cash flow, whatever your goal is, set your goals in those type of terms, and then put together a plan that buys property so you can buy the property and own it free and clear one day and get you to that goal.
Well, that's great information, John. Do you want to just reiterate the class information so people can go ahead and register and give us the web address for that as well?
Okay, yeah. If you're going to register for the class, and it's Peter Fortunato and John Schaub, we're going to be teaching in Tampa, Florida, April 5th and 6th, 2025. It's a two full days class. There's no sales here. This is not a sales event. This is just an educational event. The price is $595, and that includes the workbook we'll put together. And we're going to talk about a lot of things that'll help you here in the next couple of years to both protect what you have and to expand what you own. Be able to buy on terms which will allow you to afford them and give you some cash flow right away. We'll also be talking about managing installment sales, exchanging options, deferring taxes, joint ventures, and lots of other things. These are all things that we've done. This is not theory. Everything we talk about in this class is real. Our deals we've done. We'll explain why we've done them, how we've done them, and so you can repeat them. I just gave a speech to the local Sarasota RIA here a couple of weeks ago. Fella came up to me after the speech. He said, "John, I've taken your class over and over again. I've read all your books, all your seminar stuff." He said, "You said things today that I've never heard before, that I've never thought of before." And that's exciting to me. And that's one reason we teach, is because even if you've heard a lot of things, sometimes you're not ready for that idea, and when you're ready for that particular idea and you hear it, then you can go out and capitalize on it. In our Tampa class, we'll have people from all over the country. We'll have some of our most successful students there, people that own tons of real estate. And you can talk to them as well as talking to us and learn from them about how they did it. And that's very inspirational, especially if you're just getting started in this business, to see other people who look just like you and talk just like you who've actually done this, and Peter and I have actually done this too, of course, but we're up on the stage, but there'll be many people in a room who've done much more than we have actually, and you can hear from them and learn how they did it and why they did it, and it's just it's a unique opportunity to get together with people who think a lot alike, and who have goals to obtain financial independence and doing it with real estate. So I hope you can join us. My website is John Schaub. My name just johnschaub.com. So no middle initial, no dots, no dashes, just JOHNSCHAUB.com. And on that website, you can register for the class. Again, it's $595 for 2 days.
Great, perfect. Thank you so much, John. I really appreciate it. And I will be at the class, so I look forward to seeing you then.
I look forward to seeing you again. Okay, take
Thanks,
care.
John. Take care. Bye-bye.
Bye-bye.